Welcome back to Beyond the Comfort Zone Talking Shit with King-KAMBUF. Today, we are tackling a huge topic, a really critical one. It's called Building a Profitable Dump Truck Operation 2026, presented by the services of King-KAMBUF PS. And this is not about the daydreaming part of the business. This is about a real comprehensive 15-step blueprint. It's designed to build something that's not just running, but demonstrably profitable, especially looking ahead to the 2026 hauling climate.
Exactly. I mean, it's so easy to focus on the first steps, right? You think, I'll get a truck, I'll get a DOT number, and you're in business. But our source material here, it's this incredibly detailed blueprint, and it's paired with what they call a business plan grade launch checklist.
Yeah.
And it forces you right from the jump into the foundational economics.
And that's where so many people fail.
It's where the overwhelming majority of small hauling operations fall apart. They just don't understand their own cost structure.
Okay, so let's unpack this. We need to translate this really complex process into something genuinely actionable for you, the listener. The source material gets right to it and defines what it calls the core profit equation. Lay that out for us because I think it frames this entire conversation.
It's really the only formula that matters. It goes so far beyond just, revenue minus costs. The core formula that they say governs profitability here is this. Your profit per week is roughly equal to your billable hours multiplied by your loaded rate, minus the sum of, well, everything. Your total fixed cost, your total variable cost, plus a maintenance reserve, and this is the kicker, plus a buffer for bad debt and cash lag.
Okay, I have to stop you right there. That structure. The fact that it includes maintenance reserve and bad debt cash lag right in the main formula, that's not just standard accounting. That feels like an acknowledgement of just, well, the brutal reality of the industry.
It's the entire difference between having profit on paper and actually having cash in the bank. If you don't treat maintenance as a required hourly cost, and if you don't accept the inevitability of slow-paying contractors, then a single big repair bill or one client paying 60 days late can wipe out what looked like a really profitable month.
Right.
And that leads directly to what the source calls the silent killers. There are two realities that just destroy margins in dump trucking, and new operators, they just ignore them. First one, deadhead plus wait time.
The non-revenue time.
Exactly. These are hours where the truck is burning fuel, the driver's on the clock, but you're not earning a dime. You have to price your work and dispatch your truck to aggressively minimize this.
And the second silent killer, the one that seems kind of counterintuitive when you're trying to save money.
Downtime. And the source is so clear about this, we have to emphasize it. Downtime is the #1 killer of profitability. It's not a philosophy, it's just quantifiable math.
Okay, let's quantify it right now because I think this is the aha moment for anyone listening.
Absolutely. Let's run the numbers. Let's say your floor rate calculation, which we'll get to, shows that your fixed cost, truck payment, insurance, is $200 a day, every single day. And your target revenue is, say, $1,200 for a full billable day.
Okay.
Now, you buy a slightly cheaper, older truck to save some cash, but that truck breaks down just 2 days a month. An unplanned breakdown, a hydraulic line blows, whatever. You haven't just lost the $400 in fixed costs for those 2 days it sat there. That's not the real damage. You've lost $2,400 in gross revenue opportunity.
Wow.
So that's a $2,800 net hit to your bottom line.
Boy.
All of a sudden, that cheap truck that sits is exponentially more expensive than a costly truck that runs every single day.
That completely flips the script on how you should think about buying equipment. So our goal then, the whole point of this, is maximizing utilization and protecting it with a flow rate that guarantees you can survive.
That's it. The goal of this whole exercise is for you, the operator, to build your true mathematically sound floor rate. Now, it helps to know the ceiling. The source gives some benchmarks. It notes that in certain aggressive construction markets in Washington State, for instance, a 15-ton solo truck can get around $160 an hour for standard work.
That's the target.
That's the potential. That's the environment you're aiming for. But you can't chase that maximum rate until, with absolute certainty what your minimum cost is.
Okay, let's get into it. Part 1, defining that economic foundation. Niche, demand, and pricing. So step 1 of the blueprint, defining your niche and your service model. This first decision, what are we hauling? Is it aggregates, demo debris, dirt, asphalt, municipal work? This choice seems to drive every other decision.
It dictates everything. Your specialization, what permits you need, the truck you buy, and most importantly, your potential margin. The sources break down 3 primary business models, and they each have a huge impact on how you make money.
Okay, what's the first one?
The first is subhaul. This is where you're basically a subcontractor. You're working for brokers or for the really big prime contractors.
Yeah.
This is by far the fastest way to get started and get your truck moving. You're essentially outsourcing your sales department. You just wait for the phone to ring with a load.
But the margin has to be thinner there.
Oh, it's the thinnest.
Yeah.
That broker is taking a cut, maybe 10, sometimes up to 20%, just for finding and dispatching the work. But, it's the easiest path to generating some cash flow in those first 90 days. It gets you rolling.
So a lower barrier to entry, but you're trading that margin for speed to market. What's the next step up?
The second model is direct-to-contractor. And this is really the sweet spot for a lot of growing operations. You're working directly with the people who need the trucks, the site contractors, the paving companies, the big excavation firms. And this offers significantly better margins because you've cut out that middleman.
Okay, but the trade-off here has to be much higher, right? You're not just a truck anymore. You're selling trust.
You are selling trust. That's a perfect way to put it. It requires a ton of sustained effort in building relationships. You have to become part of their critical supply chain. Your reliability has to be, impeccable. Because if your truck shows up late, their $500,000 excavator might be sitting idle, costing them thousands. And believe me, those contractors will pay a premium for a hauler that is guaranteed to be reliable and predictable.
And the third option, it sounds like the most complex.
It is. It's the most asset-intensive and highest risk. It's called material plus hauling. Here, you're not just a trucker, you become a material supplier. You are selling the product itself, the aggregates, the topsoil, whatever, and then you're delivering it. This model has the highest potential margins because you capture the profit on the material and the transport.
But the infrastructure required for that seems huge. You need way more than just a truck.
You need a whole system. You need supplier terms with quarries and pits, which means you need credit and a strong financial history. You often need a yard for storage. And crucially, you need a much, much stronger cash flow management system because you carry the cost of that inventory until your customer pays you. Think about it. If you get stuck with a net 45 payment term on a huge load of rock, you are floating the cost of the rock and your fuel for a month and a half.
Right. That's a huge risk. So beyond just the business model, the source says you also need to optimize for specific job types to avoid those silent killers.
Yes. The workflow has to protect your billable hours and kill the deadhead. The ideal scenario is optimizing for what they call short-cycle, high-volume repeat work. Think about dedicated lanes, a truck just running back and forth from a quarry to a nearby road project, or shuttling asphalt from the plant to the paving crew a few miles away. These jobs minimize deadhead, they give you predictable round counts, and they maximize every minute of your driver's time.
But so many jobs aren't that clean. What about those messy, time and weight heavy jobs?
And they're unavoidable. You're talking about landfill runs where you can be queued up for an hour, or tricky debris removal from a tight urban site. When you take those jobs, pricing your detention time correctly becomes everything. If you don't have a strict, enforceable detention policy, the clock starts after 15 or 30 minutes of free wait time, those idle hours will just eat your entire margin. Detention pay is often the only thing that makes a tricky municipal job profitable.
And a final point on this, the equipment choice itself can be a niche.
For sure. Specialty trucks, we're talking transfers, side dumps, super dumps. They are engineered to maximize the legal payload for a specific state. That often means a higher earning potential on a single load. But, and this is a big but, it comes with exponentially more complexity. The maintenance is harder, the initial cost is way higher. A new super dump could be over $300,000. And most critically, you need perfect permit discipline. If you run a super dump, you have to be an absolute expert in your state's axle weight rules and get all the required permits. One mistake there can lead to fines that wipe out weeks of profit.
Okay, let's move to step 2. Market intelligence. And this isn't just is there work out there. It's about mapping active demand and, more importantly, spotting the cash flow risks before you even take a job. The source says, here's where it gets really interesting. You need to map active demand in a 50 to 75-mile radius. What does that mean in practice?
It means your market map is your sales blueprint. It's not theoretical. You need to list the material providers, all the quarries, the asphalt plants, the concrete plants, and then you list the high-volume end users, the landfills, the transfer stations, and probably the top 30 to 50 excavation and paving companies in your operating zone.
And the intel you gather isn't just what do you pay?
No, it's how do you pay? That's the most important question. You have to establish the rate basis. Is this market hourly? Do they pay per load? Is it a 10-mile charge? And you need to know if they have a minimum, 4-hour minimum for any dispatch. This helps you build your revenue projections.
Now let's talk about that invisible risk you mentioned earlier, the cash flow pain points, the source of that bad debt cash lag.
This is so critical. You have to ask about payment terms before you agree to anything. Are they net 7 or net 14, which is fast? Or are they net 30, or, as is really common in big construction, net 45? And then you have to ask about retainage.
Explain that for listeners who aren't deep in construction finance. What is retainage and why is it so dangerous for a small hauler?
Retainage is a percentage, usually 5 to 10% of your invoice that the prime contractor holds back. And they hold it until the entire project is substantially complete. That could be 60, 90, even 180 days later. So if your target customer pays net 45 and holds 10% retainage, your little business has to operate for months while a tenth of all the money you've earned is held hostage. If you aren't ready for that cash flow hit, your need for working capital just skyrockets. You end up taking expensive loans just to buy fuel.
So that buffer in the profit equation is specifically for this.
It's designed to buffer against this predictable reality. You have to know this friction going in.
So we need to price for it or have the cash reserves for it. Beyond money, what other friction points can a new company use to get a leg up?
You need to talk to the people on the ground. Go talk to site foremen and project managers. Find out what drives them crazy about their current haulers. Is it no-shows, trucks that are always late, messy tickets that are hard to read, unsafe drivers? If you can walk in and promise and then deliver ironclad reliability, absolute safety, and clean, immediate paperwork, for instance, invoicing within 24 hours with a photo of the signed ticket, then you stop being a commodity and you start becoming a strategic partner. And that lets you command a premium rate.
And finally, seasonality. In this line of work, that's a huge factor.
Massive. You have to know the local weather cycles. If you're in a northern market, you might have 4 or 5 months of seriously reduced demand because the ground is frozen. But you still have to cover your fixed costs during those months. That massive annual insurance bill doesn't care if it's snowing. So you have to know when the busy season is, that ramp up and the peak, to absolutely maximize your billable hours and build up a cash reserve when the work is there. That reserve isn't just for a new transmission, it's for surviving January.
Okay, this brings us to what feels like the heart of the whole thing. Steps 3 and 9, building the true floor rate. This is the exercise. If you get this wrong, you're basically just working for free. We need to break down the P&L line by line.
The floor rate is the price below which you are actively paying to work for your customer. It's that simple, and to calculate it, you have to track both your cost per hour and your cost per mile because different jobs are billed in different ways.
Let's start with the easy ones. Fixed costs.
Okay. Fixed costs, these are the bills you pay 365 days a year, whether the truck runs or not. Number 1 is your truck payment or your lease cost. Then, the big one, commercial insurance. For a new carrier, this can easily be $12,000 to $20,000 a year, up front. Then you add your plates, your permits, parking if you need it, accounting fees, your ELD subscription, all of it. Okay, those are the unavoidable ones. Now, the variable costs, the ones tied to working. The biggest one here is fuel. And again, let's be realistic. We're talking 5 to 6 miles per gallon.
Yeah.
This makes every single gallon, every route you take, every minute you spend idling absolutely critical. Then you have tires. Dump trucks just destroy tires. You have brakes, hydraulic hoses, DEF fluid, oil changes, and then any direct dump fees or disposal fees you have to pay.
Right.
And crucially, you have to include driver pay, but not just the hourly wage. You have to calculate the full payroll burden. This means you add in the employer side of payroll taxes, unemployment insurance, workers' comp premiums. That can add 20, 30, even 35% on top of the driver's gross wage. So if you budget $30 an hour for the driver, your real cost is closer to 40.
And now for that hidden cost that has to be budgeted for the maintenance reserve, how do you calculate that in a real way?
You have to calculate it based on hours run, not on how much money is in the bank at the end of the month. A good industry standard is to set aside a minimum of $10 to $15 for every single hour that truck's engine is running. Let's use the low end, $10 an hour. If you think you're going to run 2,000 hours in a year, you must set aside $20,000 in a dedicated savings account. That money is not profit. That money is for the scheduled maintenance, the unexpected blown tire, and the inevitable $10,000 transmission job. If you don't collect that $10 an hour from your customers, you are literally borrowing from your future self to pay for today's operations. It's a death spiral. It's what protects your uptime.
So we add up fixed costs, variable costs, the full payroll burden, and the maintenance reserve. That gives us our true cost per hour. Everything above that is margin. But you still need rules to protect that margin in the real world.
Absolutely. The rate is one thing. The rate rules protect you in the field. And every operator needs clear, written rules. First, a solid minimum charge. A 4-hour minimum is pretty standard. This stops you from taking a 90-minute job that actually costs you 2 hours in travel and setup. It ensures you cover your daily costs, even on a short day.
And the most important rule for fighting that silent killer of wait time, the detention policy.
It's non-negotiable. You have to clearly state in your agreement the billing starts after a defined free period, say 30 minutes of waiting at the quarry or on the job site. You need to know exactly how long you're willing to subsidize your customer's disorganization before your meter starts running at your full hourly rate.
Right.
Third, you need to use fuel surcharges. Margins in this business are just too thin to eat huge swings in fuel prices when you're getting 5 mpg. The surcharge should be tied to a public index, like the Department of Energy's weekly price, and it should kick in automatically when the price goes over a certain baseline.
Okay.
And finally, you need premiums for after-hours or weekend work, and you need strong cancellation fees. If you dispatch a truck and the job disappears while it's on the way, you need to be compensated for that. These rules are what turn a simple rate into a profit-protected agreement.
So, what does this all mean? It boils down to this. The floor rate is your non-negotiable price for survival. It funds your repairs, it pays your people. Everything you charge above that number is your actual margin and your buffer against all the risks we've talked about. And if a customer won't pay your floor rate, you have to be willing to walk away, okay? That's a rock-solid foundation. Now, part 2, the infrastructure. This is the stuff that ensures the government doesn't shut you down and a lawsuit doesn't take everything you've built. Let's start with step 4, legal structure and federal compliance.
Right. You have to formalize the business to protect yourself. You pick an entity, usually a limited liability company, an LLC. This creates a shield between your business debts and your personal assets, your house, your car. Then you get an employer identification number, an EIN, from the IRS, and you register your business with your state.
Okay, that's the basic setup. Then comes the federal side.
You have to register with the Department of Transportation, get your DOT number, and if you plan to cross state lines or haul certain things, you might need a motor carrier or MC number. And that, right there, opens you up to the massive regulatory world of the Federal Motor Carrier Safety Administration, the FMCSA.
And the sources are really clear. This isn't just about getting a number to put on your truck. You have to be ready for an audit from day one. What should a new operator be preparing for?
You have to be immediately ready for the new entrant safety assurance program. Basically, the FMCSA watches all new trucking companies like a hawk for the first 18 months, and you will have a safety audit. They aren't looking for you to be perfect, but they are looking for you to have a system.
A system for what, specifically?
A system for mandatory record keeping. This means you need comprehensive driver qualification files, or DQFs. You need detailed, accurate maintenance records for every single thing you do to that truck. And you need flawless hours of service logs from your electronic logging device, your ELD. If an auditor shows up and you can't produce a maintenance history for the last 3 months, you fail. It's that simple.
And the drug and alcohol program just keeps getting stricter, right? What's the latest change people need to know about?
Yeah, the environment got a lot tighter late in 2024. Now, state driver licensing agencies, like the DMV, are required to check the Drug and Alcohol Clearinghouse for any major CDL transaction. This means if you, or a driver you hire, has a violation in that clearinghouse, it's now directly tied to their ability to even hold a CDL. Enforcement is just tighter than ever. Sticking to the pre-employment, random, and post-accident testing rules is absolutely mandatory.
So the real advice here is don't wait. Build the system before you haul the first load.
100%. The most actionable advice in the whole blueprint is to build a compliance binder, either physical or digital, before the truck even leaves the yard. And this isn't just a folder. It should have your written safety policy, your maintenance policy, blank inspection forms, copies of the driver's records, proof you're in a drug testing pool, all of it, organized and ready to go. The quality of that binder defines your readiness on day one.
Federal's is the baseline, but then every state adds its own layers of complexity and cost. The source material uses Washington State as an example. What are some of those state-level hurdles you have to watch out for?
Yeah, the state compliance adds multiple layers. In Washington, for example, you need State Motor Carrier Authority, which is separate from your federal number. You might need specific weight distance permits, or if you cross state lines, you need IRP and IVATO fuel tax accounts. And then don't forget the simple stuff, like getting a business license from the city or county where you're based.
And operationally, you have to be an expert on the state's weight laws.
Oh, absolutely.
Right.
Washington's a great example. If you exceed the legal weight or dimensions on a state highway, that immediately triggers special permit requirements. Those come with fees and routing restrictions. If you bought one of those high payload specialty trucks we talked about, your discipline on state level permitting has to be perfect every single day.
Okay, this brings us to a really confusing topic for people in the Washington market. Taxes, specifically the public utility tax, or PUT.
This is a huge wrinkle, and it trips people up. The WA Department of Revenue generally says that hauling for hire is subject to the public utility tax. It falls under either motor transportation or urban transportation. And it's a tax on your gross revenue from hauling stuff within the state.
But the source says it's not always that simple. It depends on whether you're doing mere hauling or performing other services. What's the difference?
This is the critical nuance you have to understand. If you're performing mere hauling, meaning you show up, they load your truck, you drive it, they unload it, that revenue is subject to the PUT. But let's say a customer hires you to buy topsoil, haul it to their site, and then use your truck's dump bed to strategically spread that material on the site exactly where they want it. In that case, you're performing a mixed service. You're supplying material and performing a site service.
And that could change the tax.
It could. Your revenue might fall under a different business and occupation or B&O tax classification, which could have a different tax rate. The point is, you have to read the state's tax guides for your specific service to make sure you're classifying your income correctly, or you're going to have a big problem in an audit. It's complex, but it's mandatory knowledge if you operate there.
Okay, let's move to step 6, insurance. We already know it's a massive fixed cost. Get the floor rate wrong, and this alone could sink you.
Insurance is the gatekeeper. It's totally non-negotiable. And for a new company with no safety history, the premiums are just staggering. You have to get the minimums. That's commercial auto liability, usually a $1 million limit, and physical damage coverage for the truck itself. General liability is almost always required by your customers to cover things that happen on their site that aren't vehicle-related. And if you have employees, workers' comp is mandatory. You might also need cargo coverage depending on what you're hauling.
But getting a policy is only half of it. The details of that policy are what get you the good jobs. What's the key tip for getting the right policy?
The single most critical tip is to skip the general insurance agent on the corner and go directly to a specialized broker who only works with commercial trucking fleets and ideally dump fleets. They speak the language because big contractors don't just ask if you have insurance. They have very specific demands. They'll require you to list them as an additional insured on your policy. They'll demand a waiver of subrogation, which means your insurance company can't sue them after paying a claim. If your policy can't provide those specific endorsements, you lose the bid, period. It doesn't matter how low your rate is, so your insurance is actually a critical sales tool.
Now for the fun part, steps 7 and 8. The equipment. And this can't just be an emotional purchase. It has to be a cold, hard, calculated decision.
The truck spec has to perfectly match your niche and your local laws. You have to choose the right configuration, tandem, triaxle, super dump that lets you maximize your payload under your state's weight limits. For example, in some states, a triaxle only lets you haul a tiny bit more than a tandem, but the registration and maintenance costs are way higher. That makes the extra axle unprofitable. You have to do the math for your specific state.
And let's revisit that uptime rule when you're deciding new, used, or lease.
We have to keep reinforcing the uptime math. Yes, a newer truck costs way more upfront, but that higher payment is often completely offset by a massive reduction in unplanned downtime, better fuel mileage, and lower repair bills. If a new truck costs $100,000 more, but it runs 50 more days a year, the $60,000 in extra gross revenue from those 50 days quickly makes that higher payment look like a bargain.
So the rule is to finance the truck that keeps running.
Exactly. The source advises getting your first truck with realistic financing. That means your projected daily revenue has to comfortably cover the daily cost of the payment, your maintenance reserve, and your insurance, with enough of a buffer for a slow day or two each week. Don't max yourself out on day one.
In maintenance, which we've already budgeted for, has to be proactive, not reactive.
It has to be scheduled and disciplined from the very beginning. You need a written preventive maintenance, or PM, schedule. It should dictate when you change fluids, your policy on tires, brake inspections, hydraulic checks. Dump trucks live a hard life. Their PM schedule is much tighter than a highway truck. You need to have a relationship with a good, reliable shop, or have the skills yourself before you take the first load. Maintenance should be a planned, predictable withdrawal from your reserve account, not a sudden emergency that maxes out your credit card.
Okay, we have the foundation and the infrastructure. Part 3 is about execution, sales, and scaling with intent. Step 11 is about establishing tight operations, and the source has a great line. Repeatable, boring systems are what print money.
That's the secret sauce right there. Operational discipline. The process has to be simple, but absolutely strict. It starts with a load assignment, then meticulous ticket collection, then timely proof of delivery. And only then can you create the final invoice. If any step in that chain breaks, you get paid late or not at all.
The key is standardized data capture.
Total standardization. Your drivers need a strict, consistent process for recording everything. Start and stop times, accurate round counts, tonnage, any fees they paid.
And the most important piece of data for protecting your margin, detention events. How do you capture those in a way a contractor can't argue with?
You have to standardize the proof. You use the tech you already have. Your ELD or GPS provides a time-stamped, undeniable record of when you arrived and when you left. Your driver should also be required to send a text or a photo to the site foreman the moment that detention clock starts. Gives them immediate notice. That professional real-time documentation is the only thing that lets you bill for wait time without a fight months later.
And the tools for this don't have to be expensive at first?
Not at all. You can start with Google Forms for driver input, Dropbox for ticket storage, and QuickBooks for invoicing. The tool is way less important than the consistency of the process. It has to be so simple that anyone can follow it so the business keeps running no matter who's driving.
And finally, route optimization. At 5 miles per gallon, every single mile counts.
Route optimization has a direct and immediate impact on your bottom line. It controls your fuel burn and your deadhead. You have to use GPS and routing tools not just to find the address, but to minimize those non-revenue miles and find the most efficient loaded route. For example, if a 10-mile detour saves you 15 minutes of sitting in traffic, you take the detour. Because 15 minutes of a driver's wage while you're sitting still is way more expensive than the gallon or two of fuel for those extra miles. Discipline in routing is discipline in protecting your costs.
Step 12 brings us back to safety, and this isn't just about avoiding a ticket. It's directly tied to your insurance rates and your very survival.
Your insurer uses your safety profile, your CSA scores, to set your premium. Bad scores mean high rates. High rates raise your floor rate and make you uncompetitive. It's a vicious cycle, so you need written, mandatory procedures for everything. Pre- and post-trip inspections, load securement and tarping, strict on-site safety rules, and a clear process for reporting defects.
The source mentions having a no-go defect list.
Yes, and this is critical. It's a written list of safety issues. Bad brakes, broken lights, a critical fluid leak. That means the truck is prohibited from moving until it's repaired. You cannot afford to gamble your entire business on a random roadside inspection that could slap you with an out-of-service violation that spikes your insurance and kills your revenue stream instantly.
And even if you're the only driver, you need to hold yourself to these standards.
Yes. You have to maintain your own driver qualification file. Keep your MVR check updated, your medical card current. You have to follow the drug testing program. And if you hire someone, that vetting process is the most important risk mitigation tool you have, because your driver's mistakes on the road become your company's liability.
Okay, let's switch gears from internal discipline to actually getting work. Steps 10 and 13, building the sales engine. This needs to be aggressive and targeted.
The goal of sales is book days, not just getting calls, but achieving consistent utilization. You have to network aggressively. You target site contractors, grading and paving outfits, quarries, and even some of the specialized brokers. But the key is to prioritize volume and consistency over the absolute highest rate on a single job. One-off hauls are fine to fill gaps, but your stability comes from having 2 or 3 anchor customers who keep your truck busy 3 or 4 days every single week. It is often smarter to take a rate that's maybe 5% lower from a customer who guarantees you 30 hours a week, rather than always chasing the highest rate and then sitting idle for 2 days.
In a service like hauling, which can feel like a commodity, how does a new company actually stand out?
Your branding should be clean, simple name, clean decals on the door, a professional Google business profile. But your real differentiator is your operational performance. It's not marketing fluff. Reliability and on-time performance are everything. We said it before. A contractor's biggest fear is idle equipment. If you can deliver a 99% on-time rate, that is your brand. Other things that stand out are clean, fast ticketing, professional invoicing, and safe, communicative drivers. That operational excellence is what builds trust and lets you command a premium.
And the checklist gives a specific order for building that sales pipeline.
It does. It says to start with 5 to 10 mid-size excavation and site contractors. They need trucks every day, but probably don't have their own huge fleets. Next, target 3 to 6 paving and asphalt companies who need that continuous, predictable delivery. Then, build relationships with 2 to 4 material suppliers to get their overflow work. And finally, have 2 to 4 brokers in your back pocket. They're useful for filling gaps early on, but you have to actively work to avoid becoming dependent on them because they will always cap your margin.
Step 14 is a big one, tightening the back office and cash flow. The source calls this the hidden reason profitable companies fail. Slow payments. You can be profitable on paper and still go bankrupt.
This is where cash flow discipline becomes a survival skill. Your back office has to be obsessive. Your systems must capture every single load with all the supporting documents, the signed tickets, the scale slips, the proof of delivery, the detention proof to back up every invoice. Then you have to bill immediately, as soon as the job is done. On clear terms, ideally net 7 or net 14. Waiting a week to send an invoice just pushes your payday back by a week.
And you have to watch it like a hawk.
You need a weekly accounts receivable review. No exceptions. Every single week you look at who owes you money, how long they've owed it, and what the next collection action is. If an invoice hits 30 days, a phone call gets made on day 31. You cannot let these debts stretch out to 60 or 90 days.
But what if you're in a market where net 45 and net 60 is just how things are done?
That's when that bad debt cash lag buffer we built into the profit equation becomes your lifeline. If you know your average customer pays in 45 days, you must have enough working capital in reserve to cover 45 days of your fixed costs and your payroll before you ever see that first payment. It means you need a real cash runway to get started.
That brings up financing options like factoring or lines of credit. When should an operator use those?
Only strategically, and only if the margin on the job is big enough to absorb the cost. Factoring, where you sell your invoices at a discount for immediate cash, is expensive. They might take 3 to 5%. But it gives you instant cash. A line of credit is cheaper, but it's still an added cost. These are tools to bridge a predictable payment gap when you're growing really fast or you take on one huge high-margin job. You should never use them to survive week to week because your price is way wrong or your collections are weak. You have to know your weekly cash break-even point to know if factoring is even worth it.
This brings us to the final step, step 15, and the ultimate question. When do you add truck number 2? This feels like where a lot of people get into trouble.
They call it growing broke, and it is a very real thing. The source material lays out a definitive scaling rule, and you have to be incredibly disciplined about it. Do not add a second truck until you hit specific milestones with the first one.
And what are those milestones?
First, truck number 1 has to be consistently hitting its revenue targets. The source defines that as running 4 to 5 billable days a week for at least 6 to 8 weeks in a row. You need proven, stable demand. Second, your pricing rules, your detention policy, your minimums, they have to be proven to work, and you have to be successfully collecting on them. Third, all those systems we talked about, maintenance, dispatch, safety, invoicing, they have to be standardized and repeatable. A new truck and driver have to be able to plug right into a process that already works.
And there's a financial checkpoint, too.
It's the most critical one. You have to have built up a small, dedicated cash reserve specifically for growth. It's to cover the bigger insurance bill, a major repair, or a slow-paying new customer. Only when all those conditions are met can you even consider taking on the risk of doubling your fixed costs.
And when you do scale, there are 2 very different ways to do it.
Correct. You can add a second company truck. That gives you maximum control, but it's a huge capital expense, and it instantly doubles your fixed costs. The other option is to add an owner-operator under your authority. This requires way less cash up front, but it completely changes your job. You become a compliance manager, you're responsible for their records, for making sure they follow your safety rules, and you're relying entirely on them to maintain their truck properly. The choice really depends on how much cash you have and how much you want to manage people versus assets.
What an incredibly detailed journey. We've gone from the absolute necessity of calculating your floor rate through all the weeds of federal and state compliance, and finally into how you actually get the work and scale with discipline.
It really is a complete blueprint. It's how you shift from just being a guy with a truck to being a genuine entrepreneur in this space. And for anyone listening who wants to get started, the source provided a timed 90-day launch checklist. It's the roadmap for implementation.
Okay, break that down for us.
Days 1 to 7 are just confirmation. Confirm your niche and build that floor rate calculator. Get the maintenance reserve number in there. Days 8 to 21 are all about compliance. Form the LLC, get your federal and state numbers, build that compliance binder, and get those competitive insurance quotes that meet the contract requirements.
Right.
Days 22 to 45 are about the physical asset. You acquire the right truck, you set up its PM schedule, and you lock in your ticketing and invoicing workflow. Then, days 46 to 60 is an aggressive sales sprint. You aim for 10 focused in-person stops a week. The goal is to land 2 or 3 repeat, high-volume customers before you start chasing random one-off jobs.
And the final month.
Days 61 to 90 is all about optimization. You start tracking your KPIs, your billable hours, your deadhead percentage, how long it takes to get paid, and you enforce your standards. You raise any rates that are too low, and you start strictly enforcing that detention policy.
That's a phenomenal, actionable plan. It really shows that the hard work isn't moving the dirt, it's managing the business that moves the dirt. And the final thought the source material leaves us with is that this has to be personalized. This isn't a one-size-fits-all textbook. You have to tailor this blueprint to your specific city, whether you're driving yourself or hiring, the truck you choose, and your own personal income goals.
Yeah, and if we connect that to the bigger picture, the real work for you, the listener, starts the moment you take this framework and start plugging in your own local numbers,
Yeah.
your insurance quote, your fuel prices,
Yeah.
your market rates. The difference between a successful, profitable operation and one that just breaks even forever is the discipline to apply these systems every single week, to track that maintenance reserve, to enforce the detention rule with undeniable proof, and to review who owes you money every 7 days. Your success is tied directly to your discipline with the paperwork and your obsession with protecting your uptime.
An excellent point to end on. Thank you for walking us through this incredibly detailed blueprint on building a profitable dump truck operation 2026. We will see you next time on Beyond the Comfort Zone Talking Shit with King KAMBUF.